Good day. Dan Davis, ADK Wealth Advisory Group and Financial Planning World, coming at you from the Franklin, Tennessee office. Q3 Market Update 2025. Wow. You could say that quarter number 3 was absolutely wonderful when you take a look at performance from the stock and bond market. First time in a long time where both of them were up at the same time, and both were up quite a bit. And then you could say, economically speaking, that the economy is still growing, but at slower rates. And if you were to really break that out into detail, let's do economy first. You could say that the economy has entered into the late stage, and that's indicative of slowing growth. The problem with late stage is it has so many different media drags that hit a piece of data and then extrapolate in weird ways and make everyone feel like the recession's knocking on the doors. And the reality of it is that when you look at leading and lagging economic indicators, very low probability that we see a recession in 2025 or 2026. I would even say, and it's a bit of a stretch, that it's unlikely within 2 years. I had a client comment on the last video, says it seems like that 2-year thing continues to push out. Probably would benefit from explaining it, and that the dashboards don't really do anything beyond 2 years. Anything that you're looking at 2 years and out is garbage. So when I'm saying that, what I'm more saying is not that I think a recession is going to happen in 2 years, but that it's unlikely within 2 years, and that as data continues to come out, we'll see what, is it 18 months, what is it, that kind of stuff. And I think it's fair to say that those tools are very helpful, but they're not helpful when you're trying to figure out 6 months, 12 months, 8 months. It's not that calibrated. So when I really take a look at other parts of the economy, the Fed's lowering rates, and they're doing it while the economy is still growing. That is the epitome of a soft landing. I think the Fed's doing a spectacular job. The biggest challenge that the Fed has is inflation and President Trump. Let's do inflation first. If you take a look at going back to the 70s, 1973, till probably about COVID, you really saw a globalization move that was going on that really helped with inflation, because you're able to outsource, move high-cost stuff to low-cost manufacturing areas. And now that that's happening in ways that we're moving away from China, that's a mega trend that's going to cause inflation to be super sticky. You heard the Fed say that they don't think they're going to be able to hit their target of 2% until like 2028. I think that they won't even be able to hit it then. I think that the second piece I said that's challenging is Trump. Trump is interfering with the Federal Reserve that needs to both be independent and appear independent to have credibility in the financial markets. And Trump's intrusion in there is at best stupid, and at worst what I would classify as autocratic, and needs to stop. The reality of it is the Fed is the Fed. It's separate from the president or from Congress. And so as a result, he starts to push the Fed in a way. I think they might have lowered rates sooner than what they did, but now they have to make sure that they're not bowing to him in a way that is perceived. So it's just really a weird setup. In any case, inflation's sticky. It's going to be that way probably for 10 to 20 years. Do I see stagflation in the near term? No, I do not. Later on in the cycle, we talked recently in one of our market updates that these inflation cycles last like 20 to 40 years. We could see it, out at the end of that or something like that, but it's not in the near term. If we transition to the markets, let's do stock market first, a little more exciting. Stock market at the beginning of the year, we said probably do somewhere between 7 and 11%. We're above that at this point. You heard me in one of our videos say this has been a really weird year. It's been a good year from an investment standpoint, but really weird. I mean, if you look at a chart of the S&P 500, for example, a V-shaped recovery that's like out of a textbook, and 70%, depending on which U.S. index you look at, of the year-to-date return came in the last 3 months. Now we're videoing this on September 25th, so we're not done with Q3 yet, but in the reality, quarter number 3 has been exceptional. In the Fed lowering rates, an interesting statistic is when they do that and a recession doesn't occur and the stock market's been running, which could say what we've been having, the average rate of return over the next 12 months is 15%. Now, there's no guarantee that that's going to happen again. It's just a data point that's fairly favorable. The expectations for us between now and the end of the year is choppiness and positive returns. The international markets has probably been the one that's caught the most attention. And I would say that what's happened there is sort of short-lived. It's not something we're even trying to time or play into. The valuation of the international markets was so low compared to the U.S. And right now the U.S. markets are trading at a premium. And the international developed world's still trading at a discount. So valuations are favorable, but candidly it's been that way for 20 years and they continue to underperform. This year international developed has outperformed the S&P 500. I don't think that that's an ongoing trend. I think it's really more a fact that the dollar is devalued, which I think is more of a problematic thing of Trump's tariffs and the way that he played all of that out. Will that continue or not? I would never make a currency bet because it's harder than trying to guess the weather in St. Louis. Now, when I take a look at the bond markets has done really well as well, but the bond market doesn't do like the stock market. We thought it would do somewhere between, say, 4 and 7%. The U.S. Ag's up over 6%. We think it'll hit that 7% mark by the end of the year because now we have the Fed lowering rates. There's a variety of things that would cause me to believe that they lower it at least one more time before the end of the year, possibly twice. So much data to be released between now and then that I would say high probability once, possible twice. We'll go into what we expect for next calendar year in our year-end update. But the bottom line is I think the Fed's in a cycle where they're going to be easing / lowering rates for the coming years. Years being, like started now, I think they'll probably do it through 27. And if I were going to really talk about the Fed a little bit more in this term, the Fed's going to be in a perplexing situation of balancing lowering rates because of employment, one of their dual mandates, and fighting inflation, which you heard me earlier say is going to be sticky. It's going to be a tough thing for them. They're not going to be able to lower rates as much as they would like to based on pure economic stuff, based on what's going on with inflation. And like I said with Trump, if Trump's constantly beating the drum, they need to lower rates. They're not going to do that because he's saying that. So all that's going to do is create a headwind for them. But as I said earlier, inflation's going to be sticky for the Fed. It's going to be very problematic. I think inflation's a trend. As a result, we've put, I think it was probably about 12 months ago, we added an inflation-specific portion of our portfolio in our model at about a 5%. Our intention is to double that over the next 6 to 12 months. So if I were going to summarize quarter 3, it'd be very similar to the introduction. Wonderful performance in the markets, and we're in the late stage of the economy, but no recession in sight for the next calendar year, 2026, and probably even the next 24 months. So if you have any questions, feel free to reach out to us. We're here and available. We care about you and your family very much, and we take our job to help you navigate the financial markets and all the financial planning issues very seriously. So thank you for your trust. If you have people that are in your network, either family or friends, that you think need someone to help them with financial planning, we are bringing on new clients and would love to talk with them. Best way to do that would be just to send me an email and say, hey, I'd like to introduce you to so-and-so, and then we'll talk about it from there. Signing off from the Franklin, Tennessee office. Thank you for your time. Have a great day.